Sure, new year, new you. New year, different housing market? You're gonna have to tune in to hear what I say about the 2025 real estate and housing market. Check this out. Ladies and gentlemen, boys and girls, children 18 plus. You are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
Dio, what's poppin'?
Hey, are you still playing that creepy ass intro music?
Yes, I am.
Are you planning on changing that up ever?
No, maybe,
Has something told you that shit hits? That's why you play it?
Yes, I think any amount of time spent on like logos or creative assets, something like that, it should take no longer than 5 minutes. And that's how long I spent on it. Because anything else is just wasting time.
I would love to get like a voter poll going.
And I would love to too.
I would love to get a voter poll.
I would love to get the view. I would love to get the votes and then ignore them all.
No, John. We are men of the people.
No, Dustin. You are a man of the people. I don't give a shit about the people, Dustin. I'm just here so I can pay my electric bills. You know this. So I can play my PlayStation Pro 5.
And y'all know what sucks? This is like a truth bomb. When it comes to TLOP Entertainment LLC, This is written in the bylaws, in the operating agreement. I am 65% owner. John is 35% owner. Except, you know what this MFer did to me? He was fine giving me an extra 15% equity. He's like, bro, you got this.
I don't care about the money.
He said, when it comes to having a voice, it is 50-50.
50-50. Take all the money you want. Take all the money you want.
Just don't take away my voice.
Just don't take away my creative freedom.
Oh, God. You and Mel Gibson and Braveheart, you want that damn freedom. But I would like to hear from the people. So check this out. I don't have a way to put a poll up if you're tuning in on Spotify or Apple.
Well, I like the original one. The Jams one was awesome until we got hit with that copyright infringement.
Who sent it to us? Can we not buy them out at this point, John? You're getting that lower money now, homie.
Lower money, it's gone. As that lower money is spent before I get it deposited, Dustin. You know that.
You are an employee of one of the fastest growing. True story, by the way. Like, we got some big announcements coming on at Lower right now. Like, it makes me stoked. Because, look, I'm going to tell y'all straight up. If anyone's asking, transition is never fun. It wasn't fun when I did it for 16 years for my old company. It's not fun when I go through it. It's not fun when we do it for the new company. Now, just like at my old company, just like at my new company, we got some great human beings that go out of their way to make onboarding smooth. But I'll tell you straight up, my experience, it's like taking a pile of turds and saying, hey, I got good news for you. We're going to spray some Febreze on this so it don't smell bad, and we're not going to make you eat it.
Right.
But that's still a pile of turds, right? That's onboarding. So onboarding's never fun. It comes down to this. I got to learn your technology. I have to learn your people. Who moved my cheese? Oh, crap, I moved my cheese, right? That's in general what onboarding is like. But truth be told, I look at just in my past 120 days, the things we're creating, the things we're building, the people we're onboarding, the buzz going on in the industry, the amount of men and women reaching out to us who are like, we want to be a part of that. We want to be a part of the future of mortgage lending. We want to be a part of a mortgage company that is not only trying to become a top 10 lender, they're trying to become a top 5 lender, but more specifically, the lender. The lender that everyone else looks up to, everyone else wants to work with or work for. And it's been awesome. It has truly been awesome, but it's still onboarding.
What does that have to do with anything I said at the beginning of this
I have
episode?
no idea, John. What did you say?
Nothing.
You said something about lower and getting paid and having a say and a voice.
I said my money is spent before I get it, and then you use that as an opportunity to do a 3-minute promo saying how much you love lower.
Was that what that was? You know what? That wasn't even on the list today.
No, it's just because
that wasn't even on the list.
You love lower so much. You hope Dan Snyder makes this far into an episode. But you don't have to worry about it because you just post it on your LinkedIn and he'll heart it.
That was not even my purpose.
It's not your purpose.
It's
not your purpose, but your calling, Dustin.
I started rambling, and sometimes when I start rambling, I can't figure out where I started, and I try to make my way back, but instead I keep on going down that rabbit hole further and further and further, which makes it that much harder to circle back to get to the
I think today's topic was about like the 20.
It's going to be all about the housing market.
2025 housing market. I'll take this one. Will it get better? No. Will there still be an inventory problem? Yes. Will the cost of goods go up because of all the tariffs being introduced by the new regime? Yes. So things will cost more? Yes. Will you enjoy it? No. Will you bitch about it online? Yes. Will it be the same weather that we experienced for the past 5 years? Yes. Will everything stay the same and we'll just be in this stupid circle of endless news bullshit? Yes.
I mean, I think we're done, John.
I mean, I could have said that the last episode saved me 55 minutes. But go ahead, Dustin. Give me your predictions. Will rates go up? Moderately. I think they may come down a little, maybe by a quarter percent. Only time will tell. We don't know. Housing inventory, that's still going to be rough. And with the new tariffs coming in, that lumber from Canada, that's going to cost even more money. So you know what that means? More apartments.
Do you all know how much it pains John Coleman to have to acknowledge that he now holds this type of information up in his cranium?
I know.
That bothers you probably.
There's limited real estate up there, Dustin, pun intended.
Some people sit through like seminars or meetings and they're like, I'm getting dumber by the minute. John gets pissed. He's like, I'm getting smarter and more
God damn it.
the
more I sit here, the more I know. But just people out there, if you're wanting to buy a home and you're wondering is now the right time, probably not. Because if you haven't bought one yet, you can't afford one. So keep renting and keep burning your money because no one else will give you that kind of feedback, but I will.
Oh, well, I actually feel bad right now. Not about the people having to listen. I know they're loving this. They're like, yes, Dio, why don't you let John talk more?
Yes, he gives us the truth, Bobs.
You know, I figured out, here's the trick. I make John come in at 10 to meet me.
Yeah.
I'm usually, running around like a chicken with my head cut off, pissed off at something. And then John has to listen to me vent for over a half an hour because he knows if I don't vent, then I can't bring the energy to the podcast. Then I back him against a corner.
Literally.
And we have to get 2 episodes done in record time, which means I prevent him from being able to take his 7-minute go smoke a bowl break.
Yep.
So then I get the John Coleman, who is not numb to the world.
Now it's like focused. Hey, I think we're on a schedule. Hey, let's hit these talking points. Hey, yeah, this is what you get when you don't
let you go down to your.
When I don't have my bottle, as my wife calls it. When I don't have my baby bottle, I get antsy and I get pissy. So I need my baby bottle.
Oh, I think that people are going to love this
They
version.
do. This is awesome.
Yeah, brought to you by TLOP 2025.
Brought to you by sobriety. So go ahead, tell me, Dustin, what the 2020.
Well, you had me feeling bad. I had no intention of giving a lower plug. I really didn't. I had a point I wanted to make about that, and I didn't even know where I was going with it. So now I feel bad.
And then we'll start the episode with this. Should you trust and use a loan officer that doesn't own a home themselves?
Wow.
If my LO lives in an apartment, I'm not using them.
I'm not going to answer that.
Why? That's a great question.
I will answer that to the person who donates the most to our Patreon account. We're going there, John.
Bro, I'll do a self-deposit. So, go ahead. Answer my question. I put the money in.
Being your money's my money, that kind of doesn't really help. That's like my wife going Christmas shopping.
Yeah, of course.
Hey, look at all these gifts I bought you. You mean I bought you?
Yeah, exactly.
I didn't want that.
I know.
Yeah, I don't like gifts for that reason. I like experience. Invite me somewhere. Throw a party.
I'll invite you to the bank so you can pay off this fucking balance. I'll invite you there. Yeah.
Yeah, no. So I will get back to answering your question. Gosh.
That's a great... So no,
I have a question for you.
Okay. I'll answer it.
Yeah. When are we going to have the Patreon account up?
We all have hopes and dreams.
This podcast, we're 5 years.
By 2025.
Jesus,
That's
John.
3 weeks from now.
December 15th of 2025?
No.
Or January 15th?
Q1. Because you business people love giving them a bit. Q1.
Q1. Okay. I would like it done by January 15th of 2025.
All right.
I would also like the second YouTube channel officially launched by January 2025.
We could adhere to that.
Yeah, we're going to have 2 YouTube channels, y'all. You heard it here first. One is dedicated strictly to the podcast. The other is dedicated to all of the other content.
The crumbs of
that
content.
comes about because of the podcast or because of our coaching community.
Decades.
And one will be the Loan Officer Podcast. That is where you go and watch our podcast. The other will be something along the lines of the shit they didn't teach you in school. And that's going to be more of your 8 to 12 minute training videos, your shorter clips, the stuff that maybe is like quick hitters, but they're not all in intensive podcast episodes.
So what I heard you
And then I want us to have Patreon, John, for the podcast, because that's what all the other cool, successful, hip podcasts are doing is Patreon, because we're 5 years into doing this and we are 6 figures deep into investment. And at some point, it would be nice for the people who like us, for the people who are like, I don't want you to ever stop doing this, to give donations. I mean, look, if we had, I don't know, like 12,000 people each give $3.
If I had 12,000 people giving me $3.
Well, it is us. It's an us thing, John. All right, you were going to say something.
Yeah, don't trust your loan officer if they live in building 7 instead of having a normal address.
No, that's difficult.
That's my new one.
I'm not
Everyone has to start somewhere.
I'm going to answer your question. I'm going to answer your question. Does a loan originator that has more life experience bring more value to their client or their customer?
Yes.
I would like to believe that many professions and professionals that have more experience bring more value. But I would also say they bring a certain way of doing things, and that way may be an old school way. It may not be a modern way, or it may be tried and true, but it's not what's hip and new. And although I'm a tried and true person, there's something to be said about being a part of cutting edge. So I'm not going to say that a home buyer should not work with a loan originator who doesn't own their own home. Because what if the loan originator's team owns 12 homes combined? And what if that loan originator's job is to answer the basic questions, get the information, but it's the team coming together to actually come up with the solution, and then the originator is the one presenting the solution. So it's not necessarily fair, and like you said, we all have to start somewhere. We all have to start somewhere. And I'm one. I didn't own a home when I entered in the mortgage industry. I entered in the mortgage industry in June of 2004. I bought my first house in October of 2004.
See how I teed you up for that, Dustin?
I didn't even think about it that way.
I know you didn't think. The key word. I teed you up for it.
Okay, well, thank you. But let's go ahead and talk about the 2025 housing market. Although you so eloquently, I think you got most of it right, honestly.
What's going to go better than this year? Let's start with that.
Okay, here's what's going to go better in 2025. I'm going to start with the originators, and I'm going to slide over to the home buyers.
Okay, perfect.
In 2025, hands down, there are less of us originators chasing slightly more transactions. So when you look at the prediction of transactions for 2025, and by the way, y'all, this is not going to be good news. The predictions coming out of the industry think tanks and industry trade publications. Shout out to our friends at Housing Wire.
Shout out Housing Wire.
Yeah, shout out to Logan Motashami over at Housing Wire. Does an amazing job. I'm rocking. It's funny. If you're listening to us, you have no idea. I'm right now pointing to the hoodie that I'm wearing because it's cold enough outside in Central Florida in December. I can wear a hoodie. I'm rocking my Housing Wire hoodie today. But according to the industry think tanks and the talking heads, the predictions from just October to now we're in December, we're predicting interest rates will be higher than we originally thought. And we think that the number of transactions, the number of home sales will be lower than what we originally thought. So that's like not good news. That's basically saying, hey, we thought something was going to be X. It's going to be slightly worse. Okay, cool. But what I like about 2025 versus 2024 is going into the year, there's less originators. That's less branches, less mortgage companies, less mortgage brokers, less loan originators that are going to be chasing slightly more transactions. So even if we were chasing the same amount of transactions, that's still a win. But no, we're like, no, y'all, transactions will marginally increase, probably single digit increase. We look at number of transactions in 24 versus 25. It's going to be somewhere between like maybe a 4 to 8% increase in transactions. Mortgage rates are going to hover, in that 5.75 to 6.75 range. We may not even see 5.75. It may be closer to 6.3 to 6.9, honestly, would be the range. But just having less of us chasing those transactions automatically makes it better, right? The way that I would say it's like, going to a person's house that ordered 3 pizzas and there are 24 people there versus going to that same house and they ordered 3 pizzas and a cheesy bread, instead of 24 people, there's 18. Oh, sweet. Slightly more food, and there's less of us that have to share it. So that's, I think, a positive. If you're a home buyer, is 25 going to be better than 24? Not really. Not really. Meaning interest rates aren't going to be drastically better. Home prices are not predicted to go down. In fact, the national average. So that means if you looked at 6 of the industry leading experts and you got their predictions, and they're going to range, right? One prognosticator is going to say home prices are going to appreciate at 6%. One prognosticator is going to say home prices are going to depreciate by 1%, go down, -1. Mm-hmm. So that $300,000 house is now worth $297,000.
Oh, wow.
Yeah, exactly. Put that in your pipe and smoke, JC.
Yeah, I would love to. If you could find me that. Sure.
What would $3,000 buy you? A month's supply?
Nah, I'm not that crazy because I don't be smoking. It's just bowls, so it would last me $3,000.
Yeah.
That'd get me through a year.
There you go. So you can put that in your pipe and smoke.
Put that in my pipe and smoke it.
But no, if you average the negative point, you're basically looking at 2.4 to 3.2% home appreciation. Mm-hmm. So anyone sitting back waiting for home prices to get cheaper, that's not going to happen in 2025.
What type of individual would look to refi in 2025?
The person looking to refi in 2025 is somebody. Well, look, we always have life events. The people who are looking to buy in 2025, life events. Life events. Okay, those events. Did you get married? It's a life event. Did you get divorced? Life event. Did you have a baby? Life event. Did your babies go off to college and now they're adults on their own? Life event. Did your job transfer you? Life event. So there's like 5 major life events that will always, I don't say demand, they'll always
be there regardless of what the market and the person.
Yeah, they'll be catalysts.
All right.
They'll always be the catalyst to somebody needing to sell or buy real estate. Which is why when I entered into the industry in 2004, I told my family, like, look, I'm not getting into this for the refi boom that I just missed. I'm getting into this because people will be buying and selling homes, whether rates are 3% or 13%. And I want to focus on helping people buy and sell homes. Refinances are gravy. They're cherries on top. I do them. My company does them. I coach loan officers how to solicit and offer those services. But at the end of the day, I don't focus the bulk of my business on chasing refis. So the same life events that would cause somebody to need to refinance are also the same ones to purchase would be the catalyst to potentially refinance. Like if you and I were married and we got divorced, somebody keeps the house and somebody's got to move out. Okay, well, when that happens, if our house has a bunch of equity in it, there's a couple things that you want if you're the dude moving out, I'm the dude staying. You want your name off the mortgage and you want your equity. Well, I may have to refinance that to happen. So I'm gonna have to go to the bank, get a new home loan, get that home loan for X amount of dollars so I can give you your equity share and so I can refinance you off the mortgage. So that would be a reason for somebody to refinance. You're gonna have people that refinance because quite honestly, they're in a position financially where all of their wealth, all of their assets are tied up into their home. Whether they put a large down payment, whether they kept on applying principal payments to their home or their home just appreciated. Regardless of how their equity was created, they're waking up one day and they're saying, I owe $250,000 on a house that I bought 10 years ago, and today it's worth $650,000. I have $400,000 of my wealth. It'd be like them purchasing $50,000 worth of Tesla stock. And 10 years later, that's worth $500,000. Right? They made an investment 10 years ago. They purchased a home. That home has now gone up in value. Well, just like they could sell their Tesla stock and make that $400,000 plus profit, they can tap into their equity through a refinance. Now, sometimes they tap through their equity with a home equity line of credit, but you asked me the question on refinance, That's why they would do it.
Cool.
So they may be sitting at a rate of 3.5%, and they may have to refinance into a rate of 7%. But what if they were in a position in life where Junior needed braces, Sissy was going off to college, the car just broke down, somehow, some way, they didn't expect this to happen, and they don't know how it happened, but they're $30,000 in credit card debt, and their air conditioner on that home that they love, it's on its last leg. And oh, by the way, it'd be really nice to remodel the kitchen. But they can't afford Junior's braces. Sissy's going off to college, and mom and dad would like to be able to help her a little bit, but they can't help her fully or wholeheartedly. I guess they're going to have to go out and figure out a way to afford that $800 a month car payment because they need the new car payment. Don't know what they're going to do about the AC, but that's about $8 to $12,000 once that thing does go. And I guess that kitchen remodel is going to be a pipe dream. But they could refinance their home, and all of a sudden they don't owe $250,000. They owe $400,000. But they took $150,000 out. They bought a nice certified pre-owned car for $40,000. They paid for Junior braces worth $10,000. They allocated about $12,000 to help Sissy go off to college. It's not a lot, but at least it helps her get through the next 2 years. Mm-hmm. Maybe gives her $500 a month to groceries or utilities or books or whatever it is that they're able to do. And they have the bathroom remodeled, and they paid off the $30,000 of credit card debt. And maybe they even put about, I don't know, $25,000 in a savings account so that they can figure out the next time life throws them a curveball, they quit putting on a credit card and they're going to that 6-month emergency fund that they put together. Hmm. That would be a reason why in 2025 somebody would refinance. It's going to be because a life event has forced them to do so, such as divorce, or they're staring at their overall wealth or financial picture, mm-hmm. and all of their money is tied up into their home, and they need access to it so that they can put themselves in a much safer and more comfortable financial position. And they do so by tapping into the equity through a cash out refi.
Well said.
All right. So the 2025 housing market, it's really cool. Zillow did a good job last week of really disseminating this information. And I think the headline was, it's going to be rocky. It's going to be rocky. And what does rocky mean? Rocky means a little bit unpredictable. We know where we're starting. We have a good idea where we're landing. But we know that course, that 12-month flight pattern that mm-hmm. we're going to be on, there's going to be some expected turbulence and some unexpected turbulence. Like the housing market isn't going to be great in all markets. Like we have 50 states. We have thousands of cities. When you look at even the top 100 cities, there's going to be cities that potentially are softer. Like, could Boise, Idaho be soft in 2025? Could Austin, Texas be soft in 2025? Could the west coast of Florida be soft in 2025? Could parts of New York be soft in 2025 or parts of California? Like, all of that's on the table. It doesn't mean that the national real estate market is going to be negative. It just means that certain pockets could definitely have their more than fair share of turbulence.
Give me a prediction that coming from Dustin Owen, not something that you read. Even if it's way out of left field, just be like, my gut tells me, I have no data to back this up, but I think in 2025, blah. Like, what is something that could,
I think in 2025 that we are going to have lower interest rates than we anticipated. And I think in 2025, once we have lower interest rates, we are going to see the number of transactions spike, which means we end up having a better year than what was expected. Look, prognosticators always get it wrong, right? Because if you got it right every single time, you would be predicting the future, at which point you would be a trillionaire because you'd be able to predict everything that was going to happen and place bets for it to happen. No, the world doesn't work that way. We prognosticate based on the data, and then we live life. It's like one of my favorite, I'm going to butcher it, but favorite Steve Jobs quotes says something along the lines of, you can never connect the dots looking forward. You can only connect the dots looking backwards, meaning we embrace the journey we're on and we recognize and understand that we don't have a clear path. We may have a guiding light, we may have a North Star, we may have goals that we're trying to achieve, but until we get to that next milestone, will we actually know the path that we need to take? We look backwards in order to see the path we took. So yeah, as prognosticators go, I mean, think about it. Just about every year they're going to get it wrong. There's 6 prognosticators that all gave their hypotheses, yet 2 are going to be, one's going to be far too conservative, one's going to be far too aggressive. There's going to be a couple near misses, and there's going to be one that kind of got it right. Okay, so if you're asking me, dust to know in December 2024 going into December of 2025, or sorry, January 2025, I'm going to tell you that mortgage rates will actually end up being better than expected, because I think we are finally going to see the data tell us what we already know, which is the labor market is not as strong as we think it is, and that the economy is not as robust as we think it is. And because of that, you'll see the stock market pull back, and you'll see the bond market do better, and you'll see mortgage rates potentially come down. Maybe that's wishful thinking, John. I don't know.
What's the gotcha moment that no one's talking about that you can see coming, that like, hey, no one's talking about this, but if you guys aren't aware of it, you should be? Like something, give me something that's going to happen like September of next year. Like, hey, no one's talking about it now, but it's something to look out for on the horizon. And then we can end this episode because I'm running out of memory card tape.
Gosh, I don't want to say my gotcha moment. I don't even want to think it would happen.
Why? You got to. That's why it's called a gotcha. You got to get it. So like, hey, loan officers, because you say keep your head on a swivel, take what the defense is giving you. I love my kids. Lower's awesome. You know, all the things that you preach and incessantly say. What's one thing that's like, hey, what's one thing nobody talks about? Because I could read all these publications, but I can't read. So that's why I tune into the podcast and listen from you. So, but what's one thing that, because that'll be dope, because then I can chop this clip up and like put it in black and white 5 months from now. I'm like, look at, we predict.
Political unrest.
There we go.
Political unrest, whether it's on a global level or even on a national level. I think, and it's interesting because I don't, like, you're so naive in your 20s.
Yes.
You're clueless in your teens. You're naive in your 20s. In your 30s, you're typically so caught up in you that you don't care about anything or anybody else.
That's where I am now.
Yeah. And that's, look, I lived it. Yeah. You get into your 40s and it's like, this is when the wisdom really starts to just like poke its head through, right? It's like that little turtle that's coming out from the sand, and the first thing you see is their nose and like maybe their right fin. I think it's in your 50s and 60s that turtle actually makes it to sea. In the 70s is when it actually survived and it's coming back to lay eggs. But so at 46, I don't know if I said political unrest, whether globally or nationally, as my bigger concern, because I'm now more acutely in tune to it. Whereas in my 30s, I was so self-centered I couldn't be. In my 20s, I was so naive that it didn't like ever dawn on me. Maybe this has always been the case. Maybe what I'm experiencing on the political, geopolitical, national, or international level is what my mom would say it was like living in the 60s with the Kennedys and the Cold War and the Cuban Missile Crisis. Or the 80s with the continuation of the Cold War and, you know, things that were going on in Lebanon. And, you know, so when I say that, my caveat is, I wonder if this is just the world.
As it always has been.
As it always has been. But now that I'm no longer naive or I'm no longer extremely self-centered, because I'm still self-centered, but I'm not extremely self-centered, that now I'm in my back half of my 40s. Like I'm closer to 50 than I am 40. At this standpoint, maybe I'm just more in tune. Therefore, that's why I chose that as my answer. I mean, obviously, you have another pandemic, right? That was a brand new curveball thrown at us.
Do you think we're like more prepared as a society for something like that? So if
Yes.
something like that happens, we won't see rates go like 1.5%. Like, we won't be that kind of a.
Oh, 100%. We've learned some valuable lessons. We know what to do. We know what not to do. I think that's like anything in life. Like, the more you do it, the better you get at it. I don't want another pandemic. God forbid. Now, I would like to go like relive COVID lockdown 3 weeks out of the year. I wish we'd have like mandatory COVID lockdown.
They say the movie is called The Purge, Dustin. I don't think that ends well for too many people.
But no, I don't wish that upon us. So if I have to answer your question and get this show wrapped up, what I'm going to tell you is what I just told you. Like political unrest would be like that one gotcha moment. Because I've already predicted that I don't think the economy and the labor market is going to be as strong and as robust in 2025 as many people think it's going to be. So I think a lot of what we're seeing right now post-election is emotional purchasing, right? It's hopeful investment. It's in other cases you call it a dead cat bounce. You know, it's just like a quick shot in the arm, but eventually reality is going to set in. And you're going to realize that, nope, there's been some underlying tones that have carried through for the past years. And eventually the piper's going to need to get paid. And we've even alluded to that when we talk about the budget deficit.
Right.
But I've even read some really cool information since we've probably talked about the budget deficit that reminded me that in comparison, when you like factor in for inflation and population size and GDP and everything else that goes into it, that actually we've had worse or higher deficits. And you know what? That wasn't the budget deficit. I'm sorry. That was credit cards. That was consumer debt. Elliot Eisenberg did a phenomenal job through his Econ 60, where he talked about a lot of talking heads want to discuss the concern of credit card debt. It had nothing to do with the U.S. national debt. That is an issue. Right. By the way, that is an issue. So there we go. I'm going to point my finger on that. What Elliot Eisenberg taught us was that we shouldn't be as freaked out about the dollar amount of collective credit card debt that you as consumers have, because when you compare it to the number of citizens we have compared to what we had in the past, and you shift or you change your algorithm or you account for that, and you account for how much incomes have grown, like it's actually not as big of a deal as a lot of people would make you believe it is. But the U.S. debt and the U.S. deficit is a major deal. So that would be something that could be a aha gotcha moment. If we weren't going to go political unrest, whether here in the U.S. or globally, we could say, hey, we really need to figure out and watch what's going on with that. And that could be a gotcha moment because we don't want another pandemic to happen.
Well said, Dustin.
All right. So on that note, John, that is the world according to Dio and JC as it pertains to the 2025 housing predictions. What we're calling for, a lot of what you saw in 24 is what we're going to see in 25. That's good news because look, rates can go up, they can go down,
or they can stay the same. Only one of those is good.
Only one of those is bad.
Shit.
Only one of those is bad.
Sorry, Professor.
Yes. And at the end of the day, shelter and housing is pretty high up on that hierarchy of needs.
Maslow.
And at some point, people are going to need to sell their home and buy another house. At some point, they're going to be worn down, and just realize this very well is our new normal. Get used to it. Everyone who's been waiting, I don't know what you're waiting for. This is the new normal.
Well said.
Yep. And I think we're going to see more of those people in 25 finally get fed up. They get tired of waiting and they say, F it, I'm selling my house. F it, I'm coming off the sidelines to buy. Regardless if rates are 6.3 or 6.9, now's the right time because I'm graduating college, I'm getting a new job, I'm getting married, I'm starting a family, my kids are going off to college, I want to downsize, whatever the case may be. Those life events are still going to happen. Shelter is still high up on the hierarchy of needs. Home values are not going to go down. Mortgage rates are not going to drastically just drop off a cliff. And we're going to see a lot of what we saw in 2024, except we have less mortgage professionals and less real estate professionals chasing that little bit of business. So we will feel a slight pickup, those of us that are in the industry.
Well said, Dustin.
All right. He's John Coleman. I'm Dustin Owen. You've just tuned in to the Loan Officer Podcast. Make sure you have subscribed to our YouTube channel. Make sure you have given us a 5-star review on both Apple and Spotify. Share us not once, not twice, but 3 times. Sign up for my newsletter. I write it. It comes out every Thursday. You sign up by going to our website, tloponline.com. And if you're a mortgage loan originator, a branch manager, a mortgage broker, and you need business coaching or sales training, or better yet, how about both? I invite you. Check out what we're doing at the TLOP MLO coaching community. Come become a member. Let us invest in your future success. He's John Coleman. I'm Dustin Owen. That's all the time we have for you today, but we do look forward to catching you on the next episode. Peace.